Okay, so this video is a mashup of thoughts on investing for people who have already just started and want a set of punchy and practical recommendations. So, number one, the three market movements going up, sideways, or down. When the market is going up, it's happy days, but it's when you start getting cautious as your assets are gradually becoming overpriced, and therefore the time to sell this is approaching. Now, when the market is going sideways, then you're collecting dividends, so you're all fine. You probably should stick to it, as switching to a similar asset incurs broker fees, which eats your dividends. Now, when the market is going down, you're still collecting the dividends and the stock is really cheap to buy. So this is a marketing full discount. So an analogy that Buffett likes to use is, imagine that you're walking into a clothing store and everything was 90% off. Wouldn't you buy more? If so, why wouldn't you buy more stocks when it is at its lowest? Number two, thoughts on investing when timing the market. When you make a decision to become committed to a company in that category, that means if you buy a competitor, you're not betting on a company per se, but you're betting on the industry. Conversely, if you're out of the market, then you will have missed opportunities because you can never time when it's going up or down, and the market may never return to a point where you should have entered. Therefore, you should be comfortable with the annual average correction of 15.6%. That is the annual average correction in the market, meaning that the market every year, on average, will go about 15 to 16%. You know? Therefore, you should be comfortable as well with a crisis every 7 to 10 years. It's normal in the market, it happens. Number three, diversification. The market can stay irrational longer than you can stay solvent. Nassim Taleb recommends a barbell strategy, which means having a high risk asset offset by low risk in your portfolio. This is a sound hedge strategy. For example, currencies or startup in the right for example, currencies or startups in the high risk area versus gold or bonds in the conservative area. Thus, you need to set yourself up for success by considering the following risks. A company risk. Example, Lehman Brothers. B, market risk. Example, temporary risk. The market can go down and come back up. Therefore, you should aim to diversify through bonds and real estate, and even more through alternative assets. C, industry risk. Example, industries go away sometimes. Example, old Kodak cameras. Number four, thoughts on investing via 15 uncorrelated bets. Be aware of asset correlation. For instance, real estate is about 85% correlated to stocks. US markets are 95% correlated to the international market. Through diversification, you avoid blowing everything up. You don't want to do investment well for 30 years and then something unforeseen destroys your entire pot. Thus, you're eliminating the chance of the grand slam when you diversify, but you're also eliminating the chance of the strikeout. That said, apply unbiased conventionality. People are usually pessimistic about things, but you should read books such as The Rational Optimist by Matt Ridley or Enlightenment Now by Steven Pinker or Factfulness. You learn that we've never lived in a better time in human history. The reason why you may think otherwise is that the news thrives on propagating chaos, so people justify their wasted time on absorbing info. Putting people in survival mode is so eye catching. Finally, look for intrinsic value and uncorrelated assets. Value added and reduces risk assets. Hedge that thing. When other people are engaged in a leveraged position, you should be cautious. When they're correcting, you should be buying. For example, the US economy has been growing on average 2% a year. But it usually goes like this: 4% growth, then 1%, then 6% growth, and then minus 2%. Why isn't linear? The answer is excesses. People get overly optimistic and enthusiastic about something and therefore overinvest, and then they need to cut back a notch. Excesses activities are corrected and produce losses. Every business dies, as Jeff Bezos would say. Businesses that last longer than 100 years are very few. S&P 500 is changing all the time because companies rise and fall faster than ever. How quickly technology can change everything. Think of Napster against the music industry, for example. Walmart thought that they were competing against Kmart, but they were actually competing against Amazon. So this is always changing. Finally, in summary, diversification allows you to reduce risk without compromising returns. If you lose 50% during a decline, that means that you now need 100% return in order to just get back to where you were before. There you have it. Those are my four main thoughts on investing. What are your thoughts on investing? Drop down in the comments and see you later.